Hello guys. Thank you for joining in, and I just thought we could do a quick revision before we have our test. Yeah, I do understand maybe there are a bit of some queries here and there, and I had promised that I would send a recording for the. I think there were some questions that were submitted during class, and so we didn't solve them, but I think we can do them online, okay, so that we just give you time to study. So I think quickly, one of the questions that came in, I've just pasted it here. It should be from one of the past papers, and then it has given us a synopsis of the financial position of DC company. Okay, and we have been given the non-current assets. Okay, and then we have also been given the ordinary, I mean the the shareholder equity as well. So you can pause at whatever time, and then you just have a look at that question again. But otherwise, typically this question eventually is asking us to find the WACC. But before that, of course, we are being asked to look at the issues of gearing, considering book values, and also considering market values. Again, that should be a simple exercise. So let us go straight into solving this question. Remember, you can pause it and then go straight to where we are solving now. Okay, so I thought we could have a summary of what the question is is actually saying. Okay, so two things there. From the financial statement, we are being given the ordinary shares, that the value is 2,000, or 2 million, but they are being priced at 25 ingwe per share. Okay, we have preference shareholder, shares, which are 1 million in value, and it's 1 kwacha per share. And then we have got the share premium, we have got the retained earnings, and then we have got the redeemable loans, which are 8 million. Okay, and then the market information you are able to see there, and our tax has been pegged at 30%. So again, you can pause and then look at this information so that you just confirm. Okay, so this is okay. So let us now just quickly solve this question. Okay, so the first question is asking us to look at the issues of gearing to find the gearing ratio. So from the book value perspective, then it means that we have to calculate the book value of equity, right? So book value, okay, of equity. Okay, so remember, I think when we're looking at these things, there was a topic called valuation, and I remember the first section of the valuation topic, we're looking at what is value, and we did define what book value was. Okay, so the way we are looking at book value is we are looking at the accounting figures, we are looking at the historical figures, and in most cases that is why we would have to include everything, the retained earnings, okay, the share premium, so that we show an account of of what your equity looks like, right? So so meaning that we need to add the ordinary shares. Okay, so the value of the ordinary shares, which if you inspect, you find that it was 2 million. Okay, what about the preference shares? Okay, they were at 1 million. Okay, share premium. Okay, we know that this was at 1.1 million. 1.1 million. Okay, and then we also have, the retained earnings, which were at 6,550,000, right? Okay, so meaning that the total book value, okay, this is taking us to about 10 million, 650. Okay, so we can go and look at, so that is for equity. So remember that when you're talking about gearing, we are looking at the portion of debt, okay, in the capital structure. Right? And capital structure, remember, is the combination of equity and debt. So meaning the other thing we need to look at is the book value of debt, right? So book value of debt, okay, of debt. Okay, and we know that we're looking at the irredeemable loan notes, isn't it? So the loan notes is what is forming your debt, and it was at 8 million. Okay, it was at 8 million. So in other words, calculating, so if we are to now calculate gearing ratio, okay, using book value, okay, or using book values, then what we are just simply saying here is that we'll say that this is going to be equal to your debt, okay, over debt plus what? Plus equity. Okay, and so this is definitely going to be equal to your 10,650 million, your 10,650 over the same 10 million, okay, 650, okay, plus what did we find for our debt? Debt was at 8 million. Okay, so that is, I think, taking us to 18,650, right? So once we do our revision, sorry, I've run out of space, but once we do our revision, we should be able to come up with something like 42.9%. So this is our gearing ratio. Okay, that is a portion of our debt in the overall capital structure. Okay, so that should be easy. So from the book value perspective, that is how we are going about it. But let us move on and look at how we are looking at this from the market value perspective. Okay. Okay, so now market value is telling us about what it is currently, what is the value right now, and for market values we are using market capitalization. Again, if you look at the valuation notes, okay, security valuation notes, you will be able to find where we were discussing what market value is really. Okay, and so we need to refresh our minds here. So basically what we are saying is that market value, okay, is market capitalization. In other words, market value, okay, will be equal to the share price, okay, multiplied by the number of shares, okay, outstanding. So in other words, I think we have the share price, okay, I think we have the share price. We're given 25 ingwe, so 25 ingwe, we know that that is 0.25. multiplied by the number of shares. The number of shares is probably what we don't know, but we were given the book value. Okay, the book value of the ordinary shares was given at at 2 million. Okay, so if this is a value and the price is 0.25, then we can be able to know the number of shares. So if you work it out, you find that your number of shares is something like 8 million. So 8 million is basically what you are using. Okay, is what you are using here. Okay, by the way, I've seen an error here. Sorry, the share price is the current market share price. This was when we were issuing. Okay, but the current market share price, okay, is basically 1.35. Again, you can check the information. Okay, so I will have to make an adjustment here. So here it is basically 1.35. Okay, so therefore the market value, okay, is something like your 10,000 800. So I mean your 10 million, 10.8 anyway, 10.8. And then what about the market value of equity? So this was the market this was the market value of equity, right? Of equity. What about the market value of debt? Okay, market value of debt. So market value of debt, here we're talking about oh sorry, yeah, okay, market value of debt, we can do that. So remember, we are looking at the loan notes, right? So these were trading at okay, let me just quickly check. Okay, so trading at 80 per 100 nominal. So now here what we are saying is that if we have been given the nominal value as 8 million, so for us to find the market value of this debt, then it means we have to multiply it by how much it is trading at, which is basically your 80 over your 100, and then this should be able to give you 6.4 million, isn't it? Okay, so basically that is that. Okay, and then we can also look at the market value. Okay, market value of preference shares. Remember, this is a hybrid. Okay, but it is still part of equity, so we'll have to combine it with equity as we are looking at the gearing. Okay, so the market value of preference shares. Okay, so similar to how we handled common equity, the first one there, is a similar way that we are going to handle preference shares. So again, we know that it will have to be the prevailing share price, okay, multiplied by the number of shares outstanding. Okay, shares outstanding. Okay, so for the market price per share, it is 77 ngwe. So meaning that we are looking at 0.77. Okay, and then multiplied by the number of shares, we simply have to look at what was the nominal value and what was what was the nominal value, and then what was the nominal price per share. So the nominal value was 1 million. Okay, and then the nominal price per share was 1 kwacha. Okay, what we initially issued these at. So it is 1 kwacha, meaning that the number of shares are still 1 million. Okay, meaning that you are looking at 770,000. Okay, so this we can add to this guy, okay, and then this is your debt. So remember that your gearing is basically your debt, okay, over debt plus plus equity. So if you work this out, that is equity, you combine preference shares, I mean the value of the preference shares, which is your 70,000, and you multiply it, I mean you add it to 10.8 million, okay, which gives you the value of equity here, okay, and then debt we have already calculated as 6.4 million. So that is what is going on top there. Once you do your calculations, you should be able to come up with what did I find? Okay, you should be able to come up with 35.62%. Okay, so this is when you are looking at it from the market values. Okay, again, remember, all we are doing here is when we're looking at market values, I think this is critical. We don't have to consider retained earnings or share premiums, because remember, your retained earnings, okay, is the profit that we are reinvesting back into the business. Of course, it belongs to the shareholders, okay, so we are reinvesting it back into the business. And the argument of doing so, remember, is that we are saying we are not going to give you dividends, but when you reinvest, okay, into the business is going to grow, and when it grows, its share price here, its share price will increase, okay, and so you will benefit from what we call capital gains. So in other words, because of this increase, okay, because of this increase in share price that will happen when we return the earnings, then it means that we don't have to separately account for retained earnings when we are looking at market value, market value of equity. It is already reflecting there. And that also applies even to the share premium issues, because remember that share premium, is basically, the excess that people paid at the initial issue, okay, the excess that people paid or investors paid because they believe in this company. So because they believe it, that excess is what we call share premium, and it is being treated the same way as retained earnings. We'll be talking about this more, but I think it is very important that we appreciate this concept of how we are looking at how we are looking at things here. Okay, so quickly, I think for B, we are being asked to now calculate the WACC, and we are using market values here, okay, to calculate the WACC. So we know how to go about this, because your WACC eventually, okay, which is your weighted average cost of capital, eventually would have to be, okay, the weight of debt, okay, multiplied by the cost, sorry, the weight of equity multiplied by the cost of equity, plus the weight of debt, okay, multiplied by the cost of debt, and then plus the weight of preference shares, okay, multiplied by the cost of preference shares. Okay, so this is what we are working towards. So I think we have an idea of the weights. Perhaps now we need to just see if we can calculate the cost, okay, of these of these sources of finance. So the first one that we can look at is the cost of equity. Okay, my pen is giving me problems. Okay, the cost of equity using the dividend growth model. Remember what we said. We said that the cost of equity, okay, is equal to your D0 plus, okay, sorry, your D0 multiplied by, okay, your 1 plus G, okay, all over, okay, the share price, okay, and then everything you add with G. So in other words here, what we are saying is that we are looking at D1, okay, okay, sorry, so you're looking at D1 over P, okay, plus, plus the growth, okay. So this that we have on top here, okay, is basically representing your D1, okay. Okay, and then the other things remain just like that. But remember, if we were issuing new equity here, then we would have to consider the flotation cost at the numerator here. Okay, or is it the denominator? So basically that is that. So that is where we are. So in terms of the cost of equity, we know that the current dividend, okay, or the one which is about to be paid according to the question, is 10 ngwe. So meaning that we have our 10 ngwe here, which is 0.1, okay, okay, and we want to grow it at how much? What is the growth? The growth is 9% basically, which is 0.09, okay. So we'll have to divide that by the current price. So what is the current price? The current price we're given as 1.35 plus the growth, which is 0.09. So once you calculate this, okay, you are getting to a point where you have your, okay, you have got your cost of equity being equal to 17.07%. okay, 0.07%. So the next one would be to calculate the cost of preference, okay, shares. Okay, again here this shouldn't be difficult, okay, because we know that the cost of preferred shares is equal to the dividend which has been paid or about to be paid anyway, over the market price, okay. And remember that the market price is 77 ngwe, which is basically your 0.77, okay, 0.77. So to expand this, we know that the annual dividend, okay, we were told is 7%. So it is 7% of the nominal value, which is 1 kwacha. So meaning that the dividend is your 0.07. okay, I think you can check that out. I'm sure you know where we are coming from with this. So then it will be 0.07 over 0.77, and so your price of the cost of your preferred stock should be your 9.09%. Okay, 0.9%. Next, finally, I think we need to look at the cost of debt. We need to look at the cost of debt here. Okay, and it's a irredeemable debt. But if it was redeemable, I'm sure we already know how to go about it, because then you would have to be looking at the yield to maturity. But luckily, it is irredeemable debt. So for us to calculate, okay, the cost of debt, okay, it would have to be your interest over the market price. Okay, the market price of the debt. Okay, so what do we have? Interest here is like we are trying to calculate the coupon rate, right? If it was a bond. So remember that we have been given that the face value or the par value, okay, is this debt is selling at 100 anyway per note. So 100 per note, meaning 100 is the face value, and then 9% is the interest that you are getting on that single note. So in other words, you're saying 9%, okay, multiplied or by your 100 is what is giving you your interest. Okay, and then down here we know that the market price is 80, right? I think we were told that per 100, okay, we are selling at 80, right? So basically that is that. Okay, so what are we getting? We are getting something like 11.25%. But remember that the cost of debt is supposed to be the after-tax cost of debt. Okay, so the after-tax cost of debt simply means that we need to less this by the tax rate. So it is going to be 1 minus your tax rate, which is we're given, I think it is 30%, so it's 0.3. Okay, and so we end up having a cost of debt being equal to 7.875, I think, percent. Okay, fine. So since we have found the costs of these different sources of finance in our capital structure, then we can go ahead and look at the WACC. So then the next thing is just let us go back and calculate what the weights were. Okay, so if you look at if you remember what we did in terms of the market values, the market value for equity, okay, your ordinary equity, was I think it was 10.8 million. Okay, the market value for preferred stock or preferred shares, okay, was equal to 770. Okay, again you can check 1,000, and then the market value for debt, okay, we found it to be at 6.4, right? I'm sure you remember this. So all you need to do now is you sum all this up, okay, and find the ratios. I think we don't have to go through this. You can always do that. So sum everything here up and then divide. So you should be able to find that the weight of equity is equal to your 0.6. Okay, cost of preferred stock, your 0.04. Okay, okay. Anyway, if you want us to put all the decimal places, we can do that to 4 decimal places. We can do that. Okay, and finally your weight of debt is 0.3562. Okay, so then finally you can now do your WACC calculation. Okay, because then all you need to do is to say that you can start with equity. So for equity, we know that we know what the weight was, right? So the weight we have found here to be 0.6009. Okay, and then you're multiplying by what the cost was. So the cost was 0.17. I'm just putting it back into decimal. So 0.17074. Okay, plus. Okay, what was the cost of what was the value, I mean, sorry, what was the weight of preferred stock? It was 0.4. Okay, 282. Okay, 84, something like that. 84, which is just here anyway. Oh, so 0.0. Okay, so okay, just a minute. Sorry, I'm doing this in real time. So again, we're saying 0.0, okay, 428. And then what was the cost? Okay, the cost was 0.09, right? Okay, 0.09. Okay, if you want to finish it, we can say 0.0909. Okay, and then lastly we can say this is going to add to this pen 0.3562. okay, and then we are multiplying with its corresponding cost, which was 0.0, okay, 7875. Anyway, so in short, the total what you find, the evaluation should be able to give you 13.46%. Okay, 13.46%. So I hope as we're practicing, we are able to find some of these solutions. Okay, I will apologize that I'm maybe moving a little bit slow, but this is because I'm doing it in real time. So I may make some mistakes here and there, but you should be able to bear with me. Okay, so I think for this question, again, it is similar to what we were looking at. Okay, in the previous question, in that the information that we have been given from the balance sheet is in such a way that this is the book value, okay, of the ordinary shares, and we know that for us to find the market value, we need to find the number. First of all, it will have to be the price and then the number of shares. Okay, and then for us to find the number of shares, we know that we would have to divide by this 15 way here, because that is how much a share is selling at. So if this is how much we have raised, then how much was it? I mean, how many shares were those that we issued at this much to raise that much? Okay, so that is what that information will be useful for. As we are calculating the market values, especially maybe the WACC, using market values, we don't have so much use for these reserves. Again, it's a similar explanation to why we are not taking into account the retained earnings and the share premiums, because all those are part of the reserves. Remember, we are already taking account these things in the market price. Okay, so this market price is already taking into account the retained earnings and so on. That is why we don't say that you are buying a share of retained earnings, right? You're buying a share of equity, right? And it just turns out that your retained earnings are part of that. So we make this mistake a lot, and the problem with adding retained earnings to our maybe the weights when we're looking at market value is that you'll be mixing a historical figure or a book value figure, you are mixing it with market values. Again, that is an anomaly. So that is where I'm constantly stressing that when you are looking at market values, market weights, please let us try and not include the retained earnings. Okay, so that is basically that, unless we are looking at, I think there is a question 11 that we'll look at. I will explain again there. So that is that. So and then the preference shares, we know that this 9%, okay, will be used for us to find what the dividend is. So it will multiply with that to find the dividend, okay, especially when we are trying to calculate the cost of preferred stock. But for us to find the weights, basically to find the market value of this, we'll have to use, because if this is the value, then it have to, one quarter will be divided into that, okay, so that we find the number of preferred shares. Again, we'll have to multiply by the corresponding price, market price, which is this guy. So again, it will come here, okay, again it will come there, okay. And then for debentures, this is the debt item that we have in this structure, and it is basically 14% of it is 14%, right, okay, of par value. So this is what we are using to calculate the coupon, right, the coupon rate. Okay, so what is interesting here is that these debentures have been quoted at par. Okay, so you know the previous one, it was 80 over 100. Okay, and that is why we did those mathematics. But for this one, we are saying it is at par, meaning that it is basically 100 over 100. Okay, okay, fine. So meaning that it will be easy, because then the cost of the cost of these debentures, okay, before excluding tax, will simply be this same 14% here, okay, when it is at par. And then of course, when you now do the after tax cost of capital, then it will just be 14%, okay, and then you basically account for the tax, which is your 0.03, your 0.33, okay, something like that. So for this question, I think I would rather you maybe do it on your own. It's as simple as I have explained it, and I'm sure a majority of you have already attempted it. I don't want this video to be too long. Yeah, so I think you can do something here. Let me see if maybe there's any part which might be difficult to calculate. Okay, so for instance, if we started with the cost of equity, which is your dividend, we'll use the Gordon dividend model, the growth model. So cost of equity, again here we know that it is, in this case we have already been given D1, so we'll simply say D1 over P plus G. Okay, this can easily be found. Okay, that can easily be found, because we're told that the next dividend is basically 4 ngwe, right, so which is 0.04 of the current price. I think we're given as 8 ngwe, so again this is 0.8, okay, plus the growth rate, which I think we're given at 12%. So basically you have your value there, okay, for equity. Okay, yeah, so you have the value for equity. So for preferred stock, okay, again here we know that it is the dividend, okay, over the current price, isn't it? Over the current price. Okay, do over the current price. So here, what was the dividend? Okay, so the dividend is it's basically the 9% of 1. Okay, because we know that the nominal value is 1, right? So the 9% of 1 over what is the current market price? The current market price is 72 ngwe, so that is 0.72. Again, you should be able to find that. Okay, and then cost of debt. Okay, like I said already, because this is at par, then it is the 14%, and then you're just taking into account the tax rate. Okay, which is 0.33, and then you should be able to have that. For the weights, again, remember you are using market values, right? For the weights. Okay, so because we are caught like this one, like the weight for debt, remember that it has been quoted at par. Okay, so because it has been quoted at par, then it means that okay, the nominal, okay, it means that the market value actually, okay, the market value, okay, will be equal to the nominal value or the book value. Okay, in other words, what has already been given there as your 5 million is what is going to be the market value. Okay, but for these others, the other two, we know that the trick is about knowing what the current market value is. Okay, I mean the current price per share is, okay, multiplied by the number of shares outstanding. Okay, outstanding. And it is the same even for preferred shares. Again, here we have to know what the price per share for the preferred market price per share for the preferred stock multiplied by the number of shares outstanding. Okay, so it's just about finding the number of shares outstanding for these respectively, because we've already been given the market prices per share for them respectively. So I think this is something that we can look at on our own. It shouldn't be difficult to do. Okay, and then eventually you can calculate the WACC once you do the weights. Okay, so let's see if we can maybe just we can have an opportunity to do one more question, and then we are okay. Okay, I seem to have run out of time, or is it space? But I think what we are understanding is that when you're looking at WACC, okay, I think the best way of the advisable is that we need to find it by looking at market values. Okay, unlike book values, market values depict what is current at the moment, right? It is considering a lot of information, but historical values as presented by book values may be a bit of a challenge. And whilst we are looking at market values, I think we have said that the retained earnings are being considered to be part of equity, right? So retained earnings are part of equity. Okay, a part of equity. Okay, in fact, we said all these reserves, right? So the share premium, okay, the retained earnings are part of equity. And what we are saying is that explicitly when we find the value of equity, okay, which usually we say that price per share, okay, multiplied by number of shares outstanding. Okay, remember here we are talking about market price. Then it means we would have already taken into account these reserves here that we are talking about. One of the good examples maybe I can provide is look at a situation where someone is willing to buy pizza at 200 kwacha, for example. Okay, so if someone is willing to buy pizza, okay, at 200 kwacha, then in our case, that's what we are saying to say, okay, so for this person to buy at 200 kwacha, it means that it means that this is like the market price per share multiplied by the number of shares. What we mean here is that in this price of pizza of 200 kwacha, this price of pizza of 200 kwacha is already taking into account, for example, the share premium. Okay, now the way it would appear the share premium in the pizza concept is that look at a situation where the time that we were starting this business of pizza, there were people who believed, okay, who believed in this product, okay, the initial buyers, that they paid extra amounts, okay, so that we can make this dream of the pizza business kick off. And so it is the same thing. So for shares, okay, we are saying that sometimes companies, shareholders might pay an extra amount because of how they believe in that company, so that it can launch, and basically the dream can be possible. Okay, and then also if you look at retained earnings for this example I'm giving of a pizza business, retained earnings would be, so you make profits from, initially you start your business, you're selling your pizza, you make some profit, and then this profit you say, you know what, instead of taking this profit home, we'll push it back in the business, right? So you're pushing it back into the business so that you buy, maybe better ovens, okay, you want to buy maybe some like better equipments, okay, maybe higher quality ingredients, okay, so that you can have this amazing pizza which is selling at 200. So in other words, the 200 kwacha, okay, the 200 kwacha is already taking into account, okay, is already taking into account, okay, the fact that the pizza has got quality ingredients, okay, thanks to retained earnings, and that the pizza business has good reputation thanks to the share premium. Okay, so in other words, this 200 kwacha is already taking into account these things here. In fact, it is because of these two items plus other reserves that you can talk about that we have gotten to this point where pizza is selling at that much. Okay, so then maybe if again we said we used some more retained earnings, we put it back into the pizza business, we might find that the pizza is maybe priced at 300, and this 300 is reflective of what we have pushed in again. But remember that these are part of equity. Okay, so this share price is already taking into account retained earnings, these reserves as it were. Okay, so we can't see, we can't price them differently. So we say, okay, then you're buying for the oven that we bought, or the quality, whatever. No, already the amount is reflective of that, and this is just what we are saying about the overall point here, that you don't really need, especially when you're looking at market values, you don't need to necessarily include retained earnings, because implicitly, okay, they are actually already accounted for. All right, so thank you very much and all the best in your test. Yeah.